Can a backdoor Roth IRA, can contributing to a backdoor Roth or even mega backdoor Roth, can it save you taxes? Yes, yes it can. I'll explain that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. If you are considering a backdoor Roth or a mega backdoor Roth, there's one thing you have in common, okay? And that is you have a lot of income. You potentially are in a high tax bracket. And therefore, the question is, does doing a backdoor Roth or a mega backdoor Roth, does it help you on your taxes? Well, let's first level the playing field. What is it? Okay, and if you are contributing to your retirement accounts, pre-tax is you're contributing and you're getting a tax deduction, whether that's contributing pre-tax to your 401k or pre-tax to your IRA, you're getting a deduction on your tax return, saves you federal and state taxes. The dollars are then invested inside of that IRA, and all the growth and activity, dividends, interest, all that is sheltered from tax. And then out there in the future, you've got to be at least age 59 and a half to avoid penalties. But when you draw that money out, both what you contributed and the growth on it, that's when you have to claim it as income on your tax return. And if you say, well, I don't need it at that point, and you let it grow and grow and grow, by the time you reach a certain age 73 right now, it'll be age 75 out there in the future, the IRS forces you to calculate a minimum amount, and you've got to at least take that out. Whether you need it, whether you want to or not, you have a required minimum distribution. That's on your pre-tax retirement accounts. The Roth is after tax, okay? And just to avoid things, there's a third way of contributing, which is after tax. I'll get back to it. But the Roth is you're contributing to your Roth 401k or to a Roth IRA, and you don't get a tax benefit today. Come back to that because that's the question for the video. You don't get a tax benefit today, but those dollars, all the dividends and all the interest and all the growth, capital gains, they're all sheltered from tax, okay? And then when you withdraw those dollars, again, age 59 and a half, and with the Roth, you've got to have had a Roth IRA for at least 5 years. Then you can draw both the growth out tax-free, having never paid tax on that, and your contribution, because you never deducted it, you're not paying tax on those dollars as well when you take them out. With the Roth 401k now and the Roth IRA, there's no time point, there's no age where you're forced to start taking money out. No required minimum distribution at this time with the Roth IRA, Roth 401k. So which one's best? Should you do pre-tax? Should you do Roth? You've got to work with your certified financial planner on that. That is the quintessential financial planning question. Touches 5 of the 6 areas of your financial life directly, and therefore you got to work with your CFP on that. But if you make too much money, you are not allowed to contribute to the Roth IRA. You are not allowed to. And married filing jointly, it's around $230,000 in this year. And single, it's about half of that. There are phase outs with that as well. So if you're near that limit, you're going to want to be very aware. And then, of course, working with your CFP to see if there's any deductions you can get to stay below that phase out, below that threshold. But if your adjusted gross income is above those levels, then you cannot contribute directly to a Roth IRA. And by the way, if your income is above even a lot less than that actually, and you have a retirement plan that you're funding through work, you can't contribute pre-tax to an IRA either. So Roth IRA, you can contribute to if your adjusted gross income, so your salary, but also dividends and capital gains and all sources of income, rental income, business income, all that sort of stuff. If that's below 230, then you can fund a Roth IRA. If it's above that, above 240, that's the phase out, then you cannot contribute to a Roth IRA. So enter the backdoor Roth IRA strategy, and that is you contribute a third way to your IRA, but it's after tax. You do not deduct it because you can't. You make too much money. So you make a contribution to your IRA, and hopefully you don't have any pre-tax money in that IRA. It's just this after-tax money that you contributed. And then you can do a Roth conversion. After you've done it, it's got to be a 2-step deal where you contribute to your IRA, do not deduct it. It's an after-tax contribution. And then at some point, you convert those dollars, that after-tax money, into your Roth. Now it's into your Roth IRA. Similar strategy with the mega backdoor Roth, but instead that's a after-tax contribution to your 401k above and beyond the pre-tax or Roth contribution limits. And then you take those after-tax dollars and transfer them or convert them over to Roth IRA or Roth 401k there. So these are advanced strategies. You'll want to work with your CFP on that. But notice that, the explanation there. The question that we get from time to time is, well, should I even do this? Does it help me on my taxes? Building wealth is about playing the long game. Building wealth is about the small decisions that you make each year or from a moment by moment. Ideally, you make them automatic, that compound over time and eventually build wealth. Guys, tax savings decisions like the backdoor Roth, this is one such strategy, fits right into that natural law of how you build wealth. It's true that a backdoor Roth does not typically, it's not going to save you taxes immediately today. But over time, that means you've got more dollars into tax sheltered accounts that all the interest, all the dividends, all the capital gain, all that activity is not going to land on your tax return all along the way. And out there in the future, you will have all of that interest and dividends, that compound interest will all be tax-free when you draw these dollars, both to you and to your heirs. So while it doesn't benefit you on your taxes today, does it bring you tax benefits? Without a doubt, it absolutely will. Because if these are dollars that I don't need to consume these, I want to save them up to use them in the future or to hopefully grow for me, and then I'll use them in the future. If you could fund a backdoor Roth or mega backdoor Roth, but you say, well, I'm not going to get a tax benefit today, so what's the difference? Here's your choices. I'll just keep it in the bank. Well, the interest that you earn on the bank, does that land on your tax return? Yes, it does. And you might say, insignificant, not that big of a deal. But over time, guys, these are these micro decisions, these decisions that once you make it 1 year and then follow it the next year, it adds up significantly. And I'm working with clients right now that have $500,000 in their Roth IRAs. When they came to now in their 70s, they came to me in their late 50s, and we asked them, why aren't you guys funding a Roth? It's not that big a deal. It's okay. We can only put a little bit in there. And I think their net worth at the time was, $3.5 million, $4 million, more than what they really needed. I can't put that much in there. And I explained to them the benefits of doing it. Now, guys, they've got $500,000 in their Roth IRAs growing tax-deferred, tax-free. So if you said, nah, not that big of a deal, we'll just put it in the bank, that bank is earning interest that will land on your tax return. You're going to have to pay tax on those dollars. If you say, no, I want these dollars to work harder for me, and I'm not putting it in the bank, I'll just open an individual investment account. And by the way, I'll have a bunch of flexibility with when I draw that money out or when I need it. Yep, having that flexibility of when you can draw those dollars out absolutely is a benefit there. But all of the interest, all of the dividends, and all of the capital gains from those investments, whether you put them in your pocket or you reinvest them, that's going to show up on your tax return every year. And if you say, well, I'm just contributing $5,000 or whatever, that might seem like an insignificant amount at the time, but like that compound each year over a long period of time, it makes an enormous difference in your tax bill. It's the right small things, the wise small things done consistently over time that might even feel insignificant, but applied consistently over time, that's what helps you build wealth. And by doing backdoor Roth or mega backdoor Roth, even though it's not going to help your tax return immediately, it will without a doubt help your tax return in the long run and help you build up and accumulate more wealth because you'll have fewer dollars going to Uncle Sam. You'll have much more tax efficiency and pay less taxes along the way, whether in your generation or the next generation. So work with your certified financial planner on that. Even though a backdoor Roth or mega backdoor Roth doesn't save you on taxes today or in that immediate year, it absolutely will in the long term and each year in the future. So work with your CFP on that. If you don't have a CFP on your team, contact one of my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.